The world economy seems no less turbulent than this time last year. However, looking at these half-year results, Standard Chartered remains in growth. How have you been able to keep on track?
Actually, what I think you've seen over the last 6 months is another demonstration of the resilience of our business model. We have so many different engines of growth. It's the breadth and diversity of our business that allows us to keep on delivering. Sometimes some markets are a bit slower, but others more than make up for it. It's also the clarity of our focus. We stay very much focused on our clients and customers, on the markets in which we have a long history and understand very well, and we keep focused on the basics of banking.
But is that growth becoming harder and harder to sustain?
Well, every year brings its new challenges. But once again, we have delivered growth. In consumer banking, income is up 7%. In wholesale banking, excluding the OCA income, client income, which is the key driver of our growth of our franchise, is up 6%. There's always going to be new challenges, but if we stay focused on our clients and customers, we're in the right markets, markets that are growing rapidly, we have the opportunity to win market share, I think we can continue to grow well.
Let's just step through a few of your key markets if we can. I see that you've impaired goodwill for Korea, but what are you now planning to do to address the performance?
Well, let me first say a couple of things about Korea. First thing is we are committed to Korea as a market. It's the 12th largest economy in the world. It's the 6th largest in terms of exports. There are many very successful Korean companies exporting around the world. And for a trade finance bank, Korea is a very natural place to be and to operate. But we're also committed to improving the performance of our business in Korea. The banking industry as a whole in Korea has had a very difficult time with a very sharp reduction in the industry as a whole in profits and ROE. And we are taking action across a number of fronts to improve the performance of our business. And that includes streamlining the way we're organized, further action on costs, focusing on our core clients, moving risk-weighted assets towards those clients, playing to our strengths. These are things we're doing, reviewing some non-core businesses, options for some non-core businesses. There's no quick fix to improving the performance of our business in Korea, but we know what we need to do and we're getting on and doing it.
Take a moment to look at Hong Kong and Singapore. Quite a contrast there, I think. Hong Kong continues to be a star performer, but Singapore's a little bit more muted. Can you walk me through those two markets, those two geographies?
As individual markets, Hong Kong and Singapore have been our two largest contributors, and Hong Kong is the single largest source of profits for the group as a whole. And Hong Kong had a stellar first half with income up 14% and profits up 19% on the back of broad-based growth across a number of different businesses. Singapore had a more muted first half. Income was down 3%, but that's on the back of several years of very strong performance, both growing with the market and winning market share. And indeed, when you look underneath the headline numbers for Singapore, you actually see very good growth in volumes in our core businesses. What held Singapore back in this first half were margin pressures across both consumer banking and wholesale banking.
You talked a little to how your overall market footprint sustains you through good periods and bad periods. What are the up-and-coming markets that will sustain that future growth that you've alluded to?
Well, one of the strengths of Standard Chartered is that we don't just have markets that are delivering now, but we have markets that hold very exciting prospects for the future. Indonesia would be one, further out would be places like Vietnam. One we're particularly excited about at the moment is the entirety of Africa. We're across 15 markets in sub-Saharan Africa. They've delivered very well in this first half, and that's off the back of several years of sustained growth. We've stepped up our investment in Africa, and we see great promise, not just on what people often talk about, which is the sort of commodity flows, but also the rise of the consumer in Africa and the trade and investment corridors between Africa and the rest of Asia, which we are uniquely positioned to facilitate.
Looking at India for a second, income seems to be picking up again. What's driven this, and is the performance there sustainable?
India had a considerably stronger performance in this first half with double-digit income growth and profits up 45% in the first half. What we're seeing here is the benefits of the actions we took over the last couple of years. We saw that India as an economy was slowing. There were some stresses within the system. We took a range of actions across both businesses, and we're seeing the benefits of that. What's more, the pace of growth in our network income from India, that's business with Indian companies in other parts of the world, has stepped up again to 37% increase. So we're seeing very good growth in our wholesale franchise in India. We are, I'd say, somewhat cautious about the outlook, however, where there's still many issues that India faces, many challenges. We've seen further declines in the rupee, and of course we have an election coming up next year.
That's interesting. You've talked there to growth within markets, but also growth between markets. Is that something that's sort of evolving and becoming an important focus?
Well, the network is one of the core differentiators of Standard Chartered, and it's not just the physical fact that we're present in so many different markets, but it's the way we work, the way collaboration happens across the network to support our clients and customers. And we are putting ever more emphasis on what we call network income, so income which is originated from one country, actually executed and booked in another country. And that's what facilitates trade and investment around the world.
Let's take a moment to look at the regulatory landscape. We've seen a number of further changes there. How do you see that developing? And do you feel that the bulk of change is now behind us?
It's very difficult to judge whether we're sort of through the bulk of it. There appears to be not much let up in the pace of regulatory change. And I should stress that we are actually very supportive of the broad thrust of what has been proposed and is now being implemented through Basel III. There's no doubt that the industry needed tighter rules around capital liquidity, and we're all in favour of having more effective approaches to resolution of failed banks. Where our concerns lie is sometimes in the fragmentation, the different interpretations and way that new rules are being put in place in different jurisdictions, which creates enormous complexity. And also there is a concern around sort of unintended consequences, particularly when there's an interaction between two different sets of rules. But we are in a very strong position in terms of coping with and adapting to the new regulatory frameworks. We have a very, very strong balance sheet. We're already there in terms of the Basel III capital ratios, liquidity ratios, and so on. So we're in a position of strength.
Turning then to the outlook, Standard Chartered has an ambition of delivering a mid-teen ROE over the medium term. How are you progressing on that? And is there anything you need to do differently?
Well, in the first half, we delivered an ROE of 13.3%, so well above our cost of capital. In terms of the aspiration of delivering mid-teens in the medium term, we will continue to work at the basics, the fundamentals of the economics of our business. There's no silver bullet. It's about improving cost efficiency. It's about getting the allocation of capital even more effective. It's about controlling risks well. Of course, we'd be helped if interest rates began to rise a bit. As a deposit-rich bank, that has a benefit for us, but we're not counting on that anytime soon.
You talked quite animatedly earlier about how Standard Chartered operates in some of perhaps the most exciting markets in the world, certainly across Asia and Africa. But does it become something of a challenge to work out where to invest and in which of those exciting markets?
Well, I think it's a challenge that many others would envy, which is that we have strong positions in many of the most exciting growth markets in the world. And we have to be very disciplined in the choices we make about where we're going to invest, where we're going to deploy capital. But I'm certainly not complaining about the fact that we have a great business in China, a great business in Indonesia, we have a fast-growing business in Africa, we have opportunities in the Middle East, in India. It's a good problem to have many growth opportunities.
And what then is the outlook for the second half of the year?
Both our businesses, they start the second half, both consumer banking and wholesale banking, with good momentum, the balance sheets in very good shape. But it is a turbulent world. There are lots of economic uncertainties. The regulatory scene keeps on changing. So it's a sort of balance, I think, we start the second half with, a balance of optimism about the strength of our businesses and our franchise, but also mindful, not at all complacent about the nature of risks in the world.